Hey everyone, and welcome back to another Sunday Scan. I'm Chris with Investors Underground, and every single week we go over the most in play stocks, themes, and news so that you can get prepared to trade the markets in the week ahead. So, we had a lot of major events happen over the last couple of days. The Supreme Court struck down the tariffs in their current form. And so, Trump and the administration is basically going back to the drawing board of how can we actually continue to get some kind of tariff revenue, but structure it in a different way or under different laws. So that's going to be a major theme into the week ahead. And we also have things like NVIDIA's earnings. And of course, NVIDIA is, one of the most dominant market stocks and has such influence over the entire AI trade. So that's going to be a major, major thing this week. So we have a lot of very important things coming up in the market. At the same time, we have AI disruption plays happening. We have things in private credit that are starting to spill into the public markets. And we also have an elevated VIX environment, which could really explode one way or the other. So we're going to dive into all that and more on this Sunday scan. Before I get into any kind of chart share, I will go over the disclaimer that I'm not a financial advisor and these are not buy or sell recommendations. Everything I'm going to talk about is for educational and informational purposes only. And then last thing before I open up the charts is that Traders for a Cause is coming up this upcoming Friday and weekend. And so I'm very excited to be there to see everyone. A lot of people watch Sunday Scan who end up going to Traders for a Cause. So feel free to say hi if you see me walking around. And the conference is always just a blast. And there's so many great traders that are there and they're willing to just, chat and network and, give to great causes. So very excited for that this upcoming week. So let's get into some charts now. And the first one that I'm going to pull up is SPX. So just so you can see, the market itself, as measured by SPX or SPY, has been very range bound for the last couple of months. So why does that happen? And what are a couple of things that might help you dealing with that? So there's something called bifurcation in the market. And that is when you have two different things going in two different directions. So in SPX or in SPY, two of the major things that make that up are financials and major technology companies. And so a lot of times you'll have those going in one direction or the other. Either, both tech and financials are doing well, or both tech and financials are not doing well. And that helps the market to trend cleanly in one direction. But what tends to happen is that in a regime like this, where you have a lot of index action stalling, it's because those two sectors are going in opposite directions. So a lot of times when financials are weak, tech will be strong, and the market does nothing. Or sometimes when tech is strong and financials are weak, again the market doesn't really do much. It more just stays in this range and bounces off of these edges. So where has a lot of the action been happening in the market? It's underneath the surface of the index. It's not the index itself, unless you're kind of fading these edges on extreme moves. But what's happening underneath the surface is that you have all these AI winners, things like LITE, AXTI, MU, SNDK. You have a lot of these names that are really doing well within the AI theme. They're net beneficiaries of the AI trade. And then you have a lot of names like IGV, CIBR, and a couple others that we're going to get into that have been, pretty hurt by some of the AI disruption, and some of it's getting a little bit more extreme now. So that's just something to keep in mind that if you're in a more range-bound market, you want to look for what is the path of least resistance. And if you're constantly looking for the index itself to break out of a range, or for strategies that are based around something like that, you're going to have a much harder time than if you're just going with what is already trying to move in a certain direction anyway, unless it sets up for a major mean reversion kind of trade. So that's just something I want to highlight. We're going to get into a bunch of market thoughts and some individual names, but I wanted to recap a trade with this RXT that we had. So this was a liquidity trap that we did in Investors Underground over the last couple of days. And I kind of want to just point out a couple of things about it. So as we know, we've talked about many, many liquidity traps and the setups and how to trade them on Sunday Scan before. But a major characteristic is that you have a stock that's in play. Usually it's a smaller stock. Usually it has a somewhat limited float. This one's a little bit bigger of a float than normal, but it's still somewhat tightly controlled. So the setup still works fairly well. So a lot of times with liquidity traps, you have a big day one and a ton of volume associated with it. And that's kind of the most important thing. You need to have a massive amount of volume associated with it. And then usually what happens is that maybe they'll fade off and they'll consolidate for 1 or 2 days. And so what's actually happening is that you're like, after I see these day one moves and this huge amount of volume, I just put the ticker on my radar for a couple of days down the road in case they start to curl back up like this one did. And so we've talked about, the concept of the right side of the U. So instead of the right side of a V where you're dealing with a capitulation trade where something goes straight down and straight back up, the right side of the U is kind of when you have something setting up and consolidating. So initial leg up, and then you kind of had this rounded base and it kind of retraps down here and starts to build again. And so it's much more of a U shape. And for liquidity traps, it's very helpful to be on that right side of the U. You don't want it while it's still going down. You don't want to be anticipating too early. You want to give it a couple of days of consolidation. And then when it starts to get on the right side of that U pattern and it starts to build above prior bases. So you can see there's a base here, there's a base here. And what you want is when it's hanging around a more neutral point, like a key area around that 130 or so, that means that shorts and longs are kind of balanced with maybe who's in control here or who's offside. It's kind of just neutral. Initially, maybe you had some shorts that were doing pretty well here if they faded this initial move. But as they added in and as this grinded up, maybe it's back to their average. And as it starts to base and get above certain levels, that's when they can start to get offsides and you can have a nice squeeze out for a secondary move. And so, what am I looking for is that on the day that I'm expecting the liquidity trap to play out, what I want to do is I want to see some kind of a base form and I want to draw a line there. And so, if I'm anticipating participating in this on the long side, maybe off the open or in pre-market or a little bit after the open, what I want to do is have some kind of risk area where I want to see this hold and this base so that I can enter a long position and then use this rough area as a guide. If it's being weak underneath that area, the trade is probably not ready. But if it's starting to dip and rip into that level, like you could see right off the open, see that dip and rip, that's a sign that someone maybe sold some stock or someone maybe tried to short it and it went right into a demand zone. So that support right here held, and that dip and rip lets me know that even when that demand zone is tested, it soaks right back up. And if you have that combined with the consolidation, the right side of the U, and that support, that's a good sign that you could have a pretty big symmetrical move up here. I ended up selling this early because it was starting to stall out a little bit, but I was just being conservative as I've been in this market because things don't usually go as far in choppier markets or in more range bound markets. But so when in doubt, I just try to lock in some profits and kind of just build a cushion and keep myself in a position of strength. Because again, during more difficult market regimes like this one has been for a lot of traders, what I like to do is just, I like to chill out, just have a good padding and be in a position of strength and then pick my spots. And then when you get a market regime change, then that is when you can really capitalize. But I want to be in a good position, not overly frustrated when I'm kind of anticipating a new market coming in the near future. And based on that, we also have a new video. I did a video with Dawson. Anthony interviewed us, and it's about kind of surviving and thriving in difficult markets and kind of the mindset that's required and some techniques and strategies and actionable things that can help people to really get through markets that are maybe not necessarily in their comfort zone, but how to build strategies and use slow times to prepare for busy times and really how to make the most of it. So definitely encourage you to check out that video on YouTube. So that's just a little bit of a liquidity trap that I wanted to go over. And sometimes they turn into compounding liquidity traps where you have the same thing end up happening again. But you usually have the best odds after that initial leg consolidation for 2 days or so, and then it starts to build. So that's just a trade I wanted to go over really quickly. I'm going to go back to the daily chart and I'll take a look at NVIDIA here. You can see NVIDIA has earnings this week, and the earnings should be very good because all the Mag 7 names, really guided up on CapEx, and that feeds right into NVIDIA. But as you can see, just like with the market, during more choppy markets or more stalled markets, a lot of times even strong names, they'll just kind of consolidate instead of breaking out unless they have a very strong catalyst. So we'll see if earnings can be that catalyst for NVIDIA, if that can cause it to break out here. But if there's any misstep in the earnings, then again, you could have major knock-on effects for the AI sector as a whole. So that's just something to keep in mind. You don't want to force a bias that, it has to do one thing or the other. But if you have something that is such a market mover like NVIDIA, you just want to have it on your radar and see what are the knock-on effects after it reports. But just know that as it's been consolidating for so long, if earnings are a blowout, it's very possible that you have a nice move to the upside, unless the market as a whole is very risk off, and then most breakouts work most likely. Relative strength names, we went over a couple of these before, but these are like the AI bottleneck names. So, even though that they look overextended, and in many ways that they are, you have to take into account that there's a reason why, and it's not just retail driving this up. These are institutions that are piling in because a lot of these companies have their revenue and their earnings, going up 300%, 500% because they're in a bottleneck of the AI trade. And so they trade much more like commodity names, where you have market cycles where you have these boom and busts. So a lot of people get in trouble because they're trying to fade these too early when you need to let the cycle play out a little bit, and until it starts to act significantly different than this action here, where you just have steady ramps within a channel, consolidation, and the next leg up. That's pretty healthy action. Yes, it's up a ton, but it's also the fundamentals underneath it mirror that. Now, of course, it's unsustainable. Of course, those bottlenecks are going to resolve, but you don't want to be too early trying to anticipate the mean reversion. It's much better to either let the technicals get massively overextended from prior action. If you look in here, you can see that there's actually a recent consolidation and now it's breaking out again. So, yes, the higher it goes in absolute terms, the more vulnerable it gets to that mean reversion, but you don't want to be too early, and you don't want to just say, oh, this is up 10 times over the last year or so. You have to look a little bit further and see, okay, why is that? And are there actual strong hands that are supporting some of these moves? Because until those people start to back off, or until some of those supply chain bottlenecks are resolved, or at least there's something on the horizon that could disrupt their bottleneck, then that's when those will be really good mean reversion trades. So the moral of the story here is just don't be too early trying to anticipate that. You don't have to participate in the long side if people aren't comfortable, but just don't get chopped up trying to fade every single move just because you look at the last year and see how much it's up. A couple other things, AXTI, kind of similar, situation with a lot of these. You have things in the memory space where, again, they're just bottlenecks in the AI sector, and they're all in different stages. So AXTI seems like it's a little bit earlier on in a stage. I know that sounds crazy, but compared to some of these other moves, again, after a big consolidation, you could have another extension up here before you have that eventual major mean reversion. Because the more mean reversions it has back to those dominant trends along the way, the longer that they usually tend to last. So you could have another leg up in this, coming up soon. But really, the memory names are a good example of just what happens. You have major moves up, consolidation, and just another leg. And we're doing that again right now until you have some kind of counter trend news. So I'm going to get into the main watches now, and I'm going to start with IGV. So we've had this on watch for a while. The software names have gotten massively disrupted in many ways in this market because the AI can replace a lot of the business models fairly cheaply, and so the future is not as bright for a lot of these software companies. And then you have the technicals of this is starting to do a bouncy ball pattern to the downside, where you have a big initial leg lower, and then you have several sessions or days of consolidation, and it's starting to make lows again. But I think even better than IGV for some downside is something in particular like CIBR and some of the cybersecurity names, because you recently just had some news that Anthropic is getting into some of the cybersecurity sector. And so now these names are going to be particularly disrupted, or they're showing that they're going to be particularly disrupted. And you can see some major breakdowns on that. So CRWD and PANW will both be on watch for downside. And this actually reminds me a bit of like the Hood and Palantir kinds of moves that we had recently, where you just have these, popular names that have had a lot of consolidation up here, and now they're starting to break, below some of this key support with the counter trend catalyst. So those are just a couple of names to keep on watch for some downside. App, you had some rumors that they were doing something with OpenAI, and that started to perk up a little bit. So we need some more clarity on that, but this could be a pretty good move, especially for some options traders, because even these small moves here can have significant options moves. So once we get some more clarity on whether or not they're actually working with OpenAI, you could either have a nice reject and then test the lows, or it could start to build if the market gets a little bit more bullish. And again, we have several things happening over this upcoming week with Trump, and the administration is going to be talking about what can they do with tariffs. Are they going to have a more aggressive approach and just start slapping on major tariffs again, using some loopholes, and then the market could really not like that? Or is it going to be a little bit more of an easy transition in? Speaking of that, I think that we're going to have a major move one way or the other in the VIX. So basically, a lot of vol has been built up. And I'll mention this Investors Underground a lot. When I say vol, I'm talking about expected like volatility or implied volatility in the market in general. I'm not talking about volume. And so a lot of times when you have an elevated VIX for a period of time, it's because you have numerous macro catalysts on the horizon, or markets are pretty much just uncertain right now. So we've gotten through a few of those catalysts, like the Supreme Court ruling on the tariffs, but now we have other things like NVIDIA earnings coming up, and now we have the new tariff situation kind of that needs to get clarified in the market in this week ahead. So I think you'll either have a major blowout of the VIX if if the market's a little bit more bearish, if you get some bad tariff headlines, but if there's nothing like that, then the VIX is likely to collapse. It usually doesn't hang out at levels like this for too long before going one way or the other. So I'm expecting a major move in the VIX this upcoming week, just to be aware of. A couple other things I want to keep on radar. Hims has earnings this week. This has been a major loser in this market ever since NVO basically sued them, told them to take off their major weight loss product off of their platform. And so now that was like the major fundamental growth driver for Hims. So if they start to say something on their earnings call saying that, okay, they're going to find a workaround, they're going to be able to get something back on their platform in the weight loss product section, then they could have a major reversal here because, again, it's been sold off so far. But if they don't have a solution for basically their growth sector going away, then I expect it to hang out at the lows. So kind of on watch for both plays there. Major moves in silver again. So after we had this major run up, mean reversion, now consolidation, my bias has been for the last month that silver is just going to consolidate in a range while the miners are going to do super well. And if you look at something like AG, you can see it's starting to break out to new all-time highs, and that's been a big winner. The whole thesis was to position into the miners long on that big silver mean reversion because the miners are in a different cycle than the metal itself. Even though the metal mean reverted, the level that it fell to was still way above anything that the miners were mining previously over the last couple of months. And so the earnings were, blowout earnings and super, super good. So that's a big tailwind for the silver miners. And so that's a great sign to see. But now you're actually starting to see silver itself. Again, SLV is a proxy for that, but silver itself is actually starting to pick up again. And I actually saw some bullish flow in the options world relating to silver. So maybe they try to run it up again, but I think that even if silver starts to run again, the miners are still just going to be the go to play for that because they're in a great part of the cycle. For that. A couple other things to keep on watch. You can see gold has held up a lot better than silver, and especially if we have more tariff headlines, if we have moves in the dollar coming up this week, then gold could just be resuming its long uptrend there. So it's something to keep an eye on along with the dollar. And then a few other names. If the market gets bullish this week, BE has just been consolidating for a long time, waiting for a bullish market to release, help it to break out. But if the market's just in its range, then this might just continue to consolidate. And then you have kind of like the names that are exposed to private credit. And so BX, which is Blackstone, OWL, KKR, a lot of these names are, OWL has kind of been leading to the downside, but there's funding concerns related to the AI trade, related to the private credit sector. And so any of these names that are kind of fitting that narrative, they are kind of doing what IGV was doing a while ago, where, you just have a big sector kind of drawdown due to some factors. So those are just a few names that I'm watching for continuation to the downside, unless you have a major counter trend catalyst in something like OWL. But I think that names like BX, KKR, APO, ARES, TPG are all candidates to kind of come in a bit from that. So just something to be aware of. And then on the small cap side, MGRX, no hard bias on this, but again, like I mentioned before, if you have a stock that has a big run up and then a huge amount of volume associated with that, just goes on my radar for the next couple of days in case it starts to go sideways. We kind of know the playbook for that. You look for it to stop going down. You look for the right side of the U, and then you look for it to build above prior bases, get back to a neutral line, draw some support under, and then after 2 or 3 days, if it's still holding up, then maybe taking a long position is what I would be looking at against that support, and then maybe we get a secondary move up there. So no hard bias on it. I just want to keep it on track. But again, if you start to have dilution come into some of these names or anything like that, that can really kill the setup. So those are the main things that I want to go over for the week ahead. Again, I'll be at Traders for a Cause this upcoming week. I'm really looking forward to seeing everybody. I think it's going to be a great time, and we're going to have an active market week too. We're going to have NVIDIA earnings. We're going to have all the tariff stuff. We could have some major moves in the VIX and some other things. So there's a lot to keep an eye on. And you really just want to go with the path of least resistance. What is the market already trying to do? And if you don't know, just sit on your hands until something really jumps out at you. And that's really a key to surviving and thriving in a market like this. Make sure you catch that episode that I did with Dawson and Anthony on that topic. And you can probably find it on the Investors Underground YouTube channel. So that's all I have from me. I hope that everyone has a great week, and I'll see you at Traders for a Cause. Take care.